Hi, everyone. This is Ron Finberg, Product Specialist at Capitec. Welcome to today's Capitec Academy. The Capitec Academy is a chance for Capitec to bring in experts in other areas of regulation to gain their expertise and understanding in different areas to help you with all your regulatory updates. So on with me today is Peter Wusser from LPA, who's going to discuss a little with us about the upcoming LIBOR changes. So first of all, Peter, how are you doing? How's the whole family doing throughout the entire 6 months or so?
Thanks, Ron. Well, first of all, everybody is safe and in good health, so things are going good here. I must say I'm getting used to being at home, working here instead of buzzing around through airports every other day. So in that sense, I'm getting used to it.
Okay, that's good. Yeah, there's nothing like getting out of having to go through security every other day than being in your own house.
Exactly.
Yeah. So, as we mentioned, we're going to discuss a little bit about the LIBOR switch. So I think myself and probably much of the audience that's going to be watching this probably has heard about the different LIBOR scandals and different rate fixings that have led to the market deciding that it needs to change the way how short-term, how floating interest rates are being priced. So I guess just the first question, like what exactly happened that's leading this change taking place?
Well, I think really it's a long story about overextension. So basically LIBOR came along, I think it's sort of 40, 50 years ago. They invented it. It was basically based on this club of banks based in London, and it reflected sort of at what cost they could borrow money from each other. And then they basically started to use that to basically price up loans and bonds against it. So they would basically say, yeah, sure, we can give you a bond. If you will have to pay LIBOR plus some margin, or whatever, depending on how the market rate moved on. And you could say from the banks, it would actually be a nice way of locking in a margin profit, because they could basically say, okay, I can take the bond or the loan on the balance sheet, and I would be able to fund that balance sheet based on LIBOR. So that was sort of the original idea, and the concept is really sort of, it's actually very simple to explain and to understand, and that was probably why LIBOR became such a huge success, and it really it was the cornerstone of the development of the whole derivatives market. But basically, then what happened was, to put it in one word, Lehman, or the global financial crisis. And on the back of that, you could say with the regulatory push, with the increased liquidity that the central banks were providing, etc., the whole money market between the banks sort of vanished, disappeared. I've seen data sort of suggesting, for instance, that the US money market is down to a level that we haven't seen in real dollar terms since the late 70s. So it's not just disappeared, it's totally gone. So what do you do when you have a market that's totally gone, and where you ask people, where do you think the market is? Well, you come up with a number, you call it LIBOR. And basically you could say the traders participating in the LIBOR setting were basically guessing where the LIBOR was, because there weren't really any real transactions, which means it makes it very, very easy to start manipulating it, because especially I have a loan that fixes at that day. It could be nice that LIBOR is a little bit more expensive, or vice versa. And you could say, long story short, I think 8 banks got fined more than $10 billion in fines. So I guess that's basically where it ended in 2012. And after that, basically the market has been scrambling to figure out, how can we find something different?
Okay, so what is this new different that the market is now bringing on?
You could say that the thing is, we need to get away from this expert judgment, and we need to somehow get it really based on real transactions. And you could say one area where we actually still have transactions between banks and which still sort of represents a marginal funding cost for banks is the very, very short-term overnight lending market that's there. Either collateralized, where it's based on repos, or uncollateralized, where it's basically unsecured lending to the banks. And basically, they are taking up funds for the night. So these markets are far more liquid in terms of number of transactions. It's actually logical. If you have 1 billion of balance in that market, that gives you 250 billion of balance or volume over a year of transactions, which would be far higher than you had a 6-month rollover, 2 billion volume in 1 year if you were doing a 6-month LIBOR. So in that sense, the shortness of this rate makes it far easier to get transactions based on it.
Mm-hmm. Okay, so to explain it, so what's being suggested is just to take real trades and the real rates that are taking place in those trades, and then to wrap those up to create a new rate.
Exactly.
And those are being called the Iona. What are the different ones that are being suggested?
Actually, Ionia was the first rate of that kind, but it showed it didn't have liquidity enough, so they actually had to replace it by Ester in the European market. And if we're looking at it, the UK is using Sonia. The American market is right now shifting off Fed funds to SOFR, which is a secured rate based on repos. Swiss market is going to Saron, or has put in Saron in place, and even in the yen market we have the Tona coming in. So we have basically all of the major markets are now shifting to this overnight rate.
Okay, and these overnight rates are readily available to grab from, I guess, any Bloomberg terminal or Reuters or public?
Yes, they are actually to a very large extent public, because they are usually provided by the central banks, mm-hmm. and they are not in the business of making money off market data. So you can actually, on their home web pages, you can go directly in and see them.
Okay, so there's nothing hidden. It's more transparent than what was before, and it should be
definitely because. Yes, because we are away from this club of panel banks setting the LIBOR, and it's really recorded transactions basically reported to the central bank that is now used as basis for these rates.
Okay, I know you have a couple of slides to show. Specifically about where we at in terms of the current timelines of companies having to move over to these changes.
I think let's. I'll just share this the slide, because it actually shows very well what it's about. I just have to go down here. This is the thing. Ron, do you see it?
I got it.
Perfect. So basically, the whole story starts with, or started actually back in 2017, where at that time the head of the chair of the FCA, the Financial Conduct Authority in the UK, basically said that we are going to end support for LIBOR by end of 2021, and it has been agreed with the banks, etc. So that basically gave the market 4 to 5 years to get ready for this one. And you could say a lot of water down on the beach since then, but basically, where are we standing right now? Well, we are in the situation where we know how it's going to end. So for the vast majority of trades written on LIBOR, which are the derivatives trades, you could say over the years the market has now developed basically an approach to how do we get off LIBOR and onto the Sonia and SOFRs of this world. How do we actually do that from a practical point of view? How do we get the pricing right to do that? How are we going to basically go along with it? And you could say the last key piece there is actually the last ISDA protocol. And that's basically a set of rules by ISDA that then the banks have to accept. And once the banks have accepted these rules, everything is in place from a legal transition so that it can actually rule. The thing is, making it a little bit nerdy and interesting, that is, at the same time, we have some new legislation coming in place. So we have the UK BMR benchmark regulation. We have the EU benchmark regulation being updated, and we even have right now the Fed actively asking the New York State to change or actually give some assistance with actually doing this transition. But the thing is, the UK and the Europeans had it all figured out. They wanted it to be done in December, and that was actually also the sort of the hinted plan by the UK regulator, that they might actually sort of tell the market that LIBOR is going to end now.
Yeah, the great "let's end everything before Brexit" solution.
Exactly. But now, basically, ISDA came out a week ago or something and said, "Hey guys, we got a problem." It was actually with the Department of Justice. We got a bit delayed. So the ISDA protocol is not into effect before January next year. So it's actually going to be very interesting to see what happens. I think from a derivatives point of view, it doesn't really matter. It doesn't make the big change. But you could say for the kind of trades which are sort of still a little bit legally in the open, it will mean that we have a few weeks or a little bit longer of uncertainty. How do we actually manage those? Or can we actually use some kind of law or legislation to actually fix those? But from the big point, from the derivatives market, I think it's fairly certain that we will have an end by early 2022.
Okay, and why is it so important for the ISDA protocol? I mean, how much of the market are they involved with in terms of their associations that are working with them?
Yeah, I actually think if we're looking at it, I have it as the next slide here, and basically what we are having here is, this is the U.S. market. It's data from the ARC, the Alternative Reference Rate Committee in the U.S. And it's basically sort of split along asset classes here. And just look at the numbers. The dark blue here are the biggest numbers in this chart here. And we actually see that the over-the-counter derivatives, the OTC derivatives, account for way the largest portion or the largest volume of the LIBOR contracts, the US dollar LIBOR contracts. And since all of these contracts are somehow directly governed under ISDA, they're usually transacted under ISDA, documented under ISDA. Mm-hmm. It makes ISDA sort of the natural point to go to, well, we have a little problem. We want to change LIBOR for SOFR here. Can you please help us? And I think, and you could say that has always been ISDA's role. We have actually another interesting thing happening here in the change, and that is, since the GFC, most of the OTC derivatives market has actually gone to become cleared or centrally cleared. So we have more than 90% of outstanding volume is actually centrally cleared at the moment. So that means that next to ISDA, we have the big CCPs in the market who actually hold, or they are the counterpart of 90% of these transactions. So they would actually be able to go in, and given their rule books, they can actually unilateral decide what will be the fallback. And they will, of course, use the same mechanism as ISDA. So we are in a situation where really the market is more or less fixed how it happens. So the derivatives market can actually follow this thing that happens. So the only place where we really are in need for legislation is actually on you could say the bilateral cash, the loan market, or the securities market, where we still have pockets of sort of problem trades lying around. And that's where we then need, you could say, some updated laws in the jurisdictions that really matter.
Okay, so going back to the swaps, so just to summarize it, so even though you have this massive market that, at least in the US, is looking at about, from your graph there, about 200 billion in swaps, since it's so centralized under ISDA and the clearinghouses, it's a lot easier for firms to come to an agreement on what they're going to do with open swaps going forward.
Exactly, and then at the same time, you have, for instance, the UK regulator, the Financial Conduct Authorities, who are basically saying, well, surprise, surprise, if you as a bank, if you are not adopting the ISDA protocol, we will come by and be prepared. We will ask you some very tough questions on how you actually manage your risk without this fallback protocol. So you have really also the regulator pushing as well.
Okay, is that like a fraction of the market? I mean, who would fall under that category of firms that are not really working under ISDA protocols?
You could say most of the market is actually documented on ISDA. You, of course, in Europe, you have pockets of, for instance, in Germany, you tend to use the German local standard between German counterparts, etc. The same in France, but really, since the CCP is going that way, there is no way that a commercial bank, having basically hedged itself in the CCP and perhaps having some client-facing derivatives, they will be pretty stupid if they don't try to follow ISDA even in their client relationships, because if they don't do that, they open up a basis risk on their book. And on the other side, if they don't offer their clients the same thing, you could argue, are they actually at market with this thing? So are they actually trying to rip off their clients by what they're proposing?
Okay, that makes sense. And just back to the swap. So once the ISDA protocols do come in place and everybody comes to agree to swap from their one leg from the floating leg from the LIBOR to a new rate, is that going to have effects on just like the pricing of it, and in terms of like collateralization swaps that companies are going to have to, you might be in the black on your swap day one, and then the next day you're in the red. So what happens over there in those?
I think first of all, what is happening is there is a mechanism in place, because we know that you could say we are going from a rate that is sort of an interbank rate, which contains a certain element of credit risk, down to a risk-free rate that is sort of constructed in a way that it really has no direct risk premium associated to it. So of course there's a basis between the two. And that's actually the nitty-gritty of the ISDA, is actually a mechanism for fixing that spread, so that you get something at least statistically equivalent when we're doing the transition. So no, if you look at your books over this transition, it will just look as normal market risk. What you're seeing, you won't see any particular jumps. The jumps you actually had earlier, for instance, with the change from Ionia to Esther, or the upcoming change from Fed funds to SOFR, there you actually have P&L jumps that are then basically compensated in the clearinghouse. But the move to the risk-free rate itself will not cause directly a jump. You'll of course have a different dynamic by then, but it will not cause a jump.
Okay, and in terms of just the market being ready for these new rates, what are you seeing? Are in terms of what's being traded, is there confusion, or seems to be that companies are ready to go with this?
I think seriously, there is still a lot of work ahead for the market. And you could say the sheer complexity of the transition that we're having, because as you can see here in this chart, it basically everything you have on the balance sheet is affected somehow or another. And there are even things on this chart that are missing. So you really have something that impacts the whole balance sheet, which means if you're a big bank, you have a lot of complexity to deal with. If you're a small bank, well, they tend to have they're a little bit simpler, but they often have a more sort of wait and see attitude, which means that they don't really like changing things if things are still in the unknown, or sort of known unknowns. They're not fully fixed yet. So that also means that some of the smaller players, they are not really there yet. And what we're seeing here, if we look at these target dates, is actually a good piece of information that we have here. We actually have target dates by when banks should stop writing new LIBOR contracts. So we are actually around 6 months away now from that you shouldn't issue a new corporate loan in LIBOR. And you need to have the replacement in place before that, of course.
Okay. And for the, there's quite a few numbers there in terms of on the consumer end. So you have like the retail mortgages, or even on a lot of those banks that are doing commercial are also doing on consumer banking. So the percentages that you have listed here, 15%, 30 to 50%, they're not as high as, let's say, what you'd have on the swaps, but they're still of consideration. And knowing that a lot of the mortgages are these long-term loans that banks are having, how are they, is there going to be effects to their consumers, to their, both their institutional and consumer clients about open loans to them?
Yeah, I think first of all, what we're seeing here are American data, and you could say I know enough about the mortgage market in the U.S. that I don't know enough. So I know that they have, you could say, everything is basically turning around the securitization of these mortgage assets which are being generated, and then they're basically being sold off on the back. And if we look at Fannie Mae, Freddie Mac, etc., they are actually the biggest issuers now of SOFR-based lending, of SOFR-based bonds. So we are already in the securitization area in the US. We are seeing a shift to SOFR. When it comes down to the kind of loan that you're actually going to get as an individual, I think that we will still see sort of a rather broad spectrum of different kinds of loans that we're going to get there, because in the mortgage lending, it's not just a question about what kind of interest do I have to pay. It's also about what about prepayments? Can I get out of the mortgage? Can I call it, etc.? That's actually important. So I don't want to really go into the depth of the US market.
Sure.
If we on the other side are looking at the European market, we are seeing that there is actually room for quite some innovation in the European market, and we are seeing a very big, not LIBOR but Euribor dependency in the European market on retail lending there, and you could say this will actually be a thing that the European market needs to prepare for in order to eventually also get rid of Euribor, because as we see, LIBOR couldn't be fixed. LIBOR is now ending. Euribor has all of the same problems as did the LIBOR.
Okay, and I know you had another slide on terms of just the spreads that the market would.
Yeah, I think it's very important to say that personally, I don't really like to make projections of saying what is happening. I actually like just looking at data. And you could see here, this is basically a chart I took it off Bloomberg 2 days ago. And what I'm looking at here is basically the spread between the SOFR 3-month future and the dollar LIBOR 3-month future. So what's the difference between these two futures? And what I'm looking at is the H2, so basically delivery in March 22. And what we're seeing here, first of all, we're seeing basically a sort of, the spread is trading very much in a band around 20 basis points. This is 20 basis points that we have here. And we see a big hump around March. And this hump is really, you could say, this hump can only exist if the market is expecting that the LIBOR, end of LIBOR, is going to be basically deferred until later. So this was early COVID. Everybody thought the world is ending and we don't have to change anything, so we'll just keep LIBOR as it is. And that basically meant here you saw the spread went up almost around 40 basis points. So it widened quite significantly. What we saw on the other side is very, very quickly it came back into the same range. And there is actually a very good reason why this spread is within this range. Because this is actually, if we assume that LIBOR is going to end by early 22, then the March future would be after LIBOR has gone. And if you look at the mechanics, sort of the statistical mechanics of the ISTA method, it's a 5-year median spread between the two contracts. It has a tendency to really it goes, since it's a median, it goes to the center of the distribution. So if you have a number of very high data points coming in or some very low data points coming in, it will not shift the center of the distribution that much, which means that you will be trading in a fairly narrow band. So you have a lot of convergence in it. And what we can see here is that it's back on the convergence. We can actually see a slight increase here a few days ago, which was actually when it was clear that the ISTA protocol might be delayed a month or so, which means it could delay basically the fixing of the spread by a month.
Okay, but overall, the data is showing us that the market fully expects us to meet those January 2022 goals of fully moving over to away from. Okay,
exactly.
I want to end on one last item. I know when we talked prior to this interview, and mentioned that you believe that there are areas of the market are probably underestimating this change, and this could lead to certain areas of innovation. If you can just provide a little bit more explanation of what you think those estimations are.
Yeah, I think first of all, it is that really what this chart is telling us here, and we can actually see it from the chart, that is the cost of borrowing for banks basically depends on the creditworthiness of banks. So if we have a COVID stress situation, the creditworthiness of the banks are going south, so the price goes up. And you could say, as a bank, I can actually, I have this cost on my balance sheet, on my liability side, no matter what I do. I have to be able to pay my own credit. So if I look onto the asset side of the balance sheet and seeing I'm having long-dated assets moving from LIBOR to risk-free rates, I'm suddenly missing this credit component. So I don't get that compensation anymore for the additional cost that I have on my liabilities. So that actually means that if I'm writing very, very long-dated assets and taking them onto my balance sheet, I have to find mechanisms to actually get compensation for that. So my expectation here is that we are going to see, once sort of the sheer hard work that is ahead of us for the next 18 months, but once we are on the other side of that, I actually expect that the banks will start to become a little bit more innovative and actually creating new solutions, both for their client base, but also for basically their investors and for the balance sheet, and basically new ways of securing streams of revenue. So coming from a situation where things have been very static for a very long time, very sort of regulatory driven, we might actually get to a point where we will see real innovation again in the financial market.
Okay, so you're basically saying that the core banking idea of lending at higher rates than you're borrowing at has been kind of stale for a number of years, and firms have to kind of reevaluate what's the best way to do this going forward once the short-term rates are going to be changing.
Exactly. So it's really sort of the core part of that banking of the banking system needs to be reinvented. You could say it's actually overdue. We see it we have these extreme low rates in a lot of the OECD countries, And that means that I, as a bank, I have to really start to look at generating new sources of revenue. And the only way I can do that is basically making sure that I, on my assets, make more money than I pay on my liabilities. Very simple. And you could say this: the banks have, together with a lot of other investors, they have basically been living off that falling rates. So they've been basically been able to bet on that and living off that. And now they have to basically be in a situation where they either have to be able to be profitable in a low rate scenario, or if we, on the other side, go back into a rising interest rate scenario, that will even put them even more under stress, which means that they might be more willing to put on floating rate assets on their balance sheet. But then again, these floating rate assets won't compensate them for the credit risk they are running.
Sure, but if rates actually start rising again, whenever everybody talks about that happening, but it never does for the past 10 years or so. And when the inevitable does take place, are these changes? Is the market better? Is going to be better or worse with moving over from LIBOR, or it shouldn't really matter?
I think it doesn't really matter, because I think, sort of looking at LIBOR, sorry to say, it's a broken system. It has to be cleaned out. It doesn't work. So we cannot be basing our business model on basically 15 banks guessing a number. That's just not credible. So LIBOR as a concept is dead. So I think that change will come no matter what. What we have to see is basically, how do I structure my business going forward? What kind of products make sense to my clients? And it's again, it's the good old rule that is, only if the product makes fun for both sides. It's if we have that situation, it's a successful product. Otherwise, it's just a dead duck.
Got it. Okay, I think it's a good place to end with your comment of LIBOR is more or less being dead right now. If any of our viewers have questions about these changes, I imagine, Peter, they could contact you or any of your colleagues at LPA to assist them with preparing with the transition.
Definitely, they are welcome at any time to contact us at LPA, or another way, reach out on LinkedIn or other social media. Send us an email. Smoke signals will be a little bit difficult to detect, but basically just come along. And I think this is probably going to be one of the most exciting changes in the industry for the coming decade or so.
Okay. Hopefully, I mean, I know on my end, when we talk about regulatory changes, everybody's like, oh, another cash outlay that I have to take care of. So hopefully this will be an area where companies can actually look at and see ways that they could profit out of.
It is, because it's really a change to the market. It's not a change to the regulatory environment. It's actually a place where I have to reassess the way that I'm doing business and working with the market.
Okay. Perfect. All right. So thank you very much, Peter, for all this information.
You're welcome, Ron.